Shares of Macy's plunging today despite beating earnings expectations. Still on deck for tomorrow, JCPenney, Walmart, and Nordstrom.
Joining us now to talk about the state of retail is Jay Soul from UBS and Liz Dunn from Pro4ma. It's great to have both of you here.
Thanks, Scott.
Liz, you want to comment on what we got out of Macy's today and what that means for the rest of the stocks, if anything?
Yeah, I think it was just a case of high expectations heading into the print. I guess the whisper expectations were much higher than the published forecasts. And so I think it was a decent print. They're continuing to make progress, but also they gave this higher guidance for the back half, which people don't always like, you know, the optics of that.
That's what you get for having a stock. I was going to say, that's what you get for having a stock go up 100% into the print.
Exactly. That always makes it more difficult.
Or else.
Is that a cautionary tale for any of the other department stores, Jay, which have also been in favor lately?
Well, you know, what I would add is that Macy's also said their gross margin in the back half of the year is going to be down and below expectations. And I think that what that says to the market is this shift from brick and mortar to online is still tough for the legacy retailers to deal with, that even though they're getting the sales online, the margins keep going down. We've seen that trend for many years. And what Macy's is saying is that it's continuing, and I think that's got the market a little spooked.
That's a good point.
Yeah.
What does it mean for the others?
Well, I think that with Nordstrom tomorrow, one unique aspect of Nordstrom is that there's this idea that there's a little bit of a floor under the stock price because the Nordstrom family has talked about taking it private at $50. So maybe that's going to protect it. But I think what we're seeing today is that the market's appetite for department stores is still not good. They still think that they're at risk from losing a lot of market share to Amazon, and I think that we're going to continue to see that play out.
The stocks in this space have done quite well.
Right.
Why is that? Were some of the Amazon concerns just overdone?
Well, I think
the environment seems pretty good. I mean, confidence is up. The economy's doing very well.
I think there are a couple of factors at play. So the economy, to your point, is doing well. The consumer is doing well. We are starting to see sales improve at these retailers. We're also starting to see, to Jay's point, an inflection point where it's not just about investment. So it's not just about top line gains and giving it all back on the margin. We are starting to see some efficiencies, and we're starting to see a balance between a focus on top line growth and a focus on operating margin stability, at least for many of these companies. And so I think the balancing act that they have to play as they compete against Amazon is definitely difficult, but we're at a little bit better point.
So as the consumer's doing well and we're finally seeing a little bit of wage growth, Jay, how do you play retail? Do you want to expose yourself to accessories or to brands or to department stores? Where do you want to be?
I think you want to be in stocks where you don't have a lot of tariff risk, where they're not importing a lot of goods from China. That's the first thing. And then I think
aren't they all importing goods from China?
Well, no, actually, Tapestry reported earnings yesterday. So Coach and Kate Spade, less than 5% of the goods imported by that company into the U.S. come from China. So those are two brands on the upswing where the valuation.
By process of your answer, you've made the pie incredible, like a one-bite pie.
You know what, Scott? It's not as small as you think. There's a lot of companies who've diversified into different parts of Asia, so they're not getting a huge amount of their business from China. And what they can do is they can send that production from China to other countries and then shift maybe what they're doing, say, in Indonesia to the U.S. There are ways these companies can deal with the situation.
So who else besides Tapestry doesn't have China?
Well, if you look at another name like Skechers, they have a very small percentage of their business that's imported into the U.S. from China. So that might be another name where the tariff risk is not as high as you might think, where the valuation is low, the fundamentals are getting better. Maybe that's a stock you can still own. A lot of the market is afraid of stocks like Lululemon because they trade at 39 times earnings, which seems kind of rich. But a stock like Skechers, which is at 14 times, or Tapestry at 17 times, seems more reasonable given valuations fundamentals are getting better.
Is that how you're looking at retail, picking winners based on supply chains?
Yeah, I think Garpier global brands are a good place to be right now. Global brands versus domestic retailers who are just sort of at the mercy of whatever the tariff structure will be. And I think global brands have more opportunity. We've seen a lot of these. I mean, last year it was kind of the self-help stories, and now they all seem to have gotten their houses in order. I think Tapestry's results yesterday were obviously impressive. Nike is another one. Tiffany, Ralph Lauren. These are good brands. Now there are some that are trading at kind of astronomically high multiples, like Under Armour, where I don't think necessarily the fundamentals have caught up with the valuation.
That's Jay's favorite stock. Just kidding. Do you still what do you think about Under Armour? Since you famously downgraded it.
Well, we rate Under Armour neutral.
With like a 300-page note.
I'm glad, Scott, you read every page. I think that, the athletic space is still strong. And I think if you want to play the athletic wear trend and the athleisure trend, Skechers is a great name. Their products are really on trend. The valuation is not as high as some of them.
Yeah, because they had an awful quarter. It dropped more than 20%.
On expenses. That's the opportunity because the sales were good. It's just some one-time expenses made that stock go down. But fundamentally, they're still on the right track.
Quickly, Liz, Walmart, what should we expect?
I think people are very focused on traffic there because the traffic has been slowing. It's still positive, but slowing. So very focused on traffic and also focused on that growth in e-commerce. It's very, very important. So they're walking a very fine line.
Okay. Great, thanks. Earnings right in front of us. That's why I asked.